While everyone was celebrating low unemployment, the government last week admitted they overstated job growth by 911,000 jobs. That's not a typo. And the latest jobs report, the economy added just 22,000 jobs in August. Wall Street expected 75,000. Instead, we got a rounding error. To make it worse, June was revised from 147,000 new jobs to a loss of 13,000. So if you've been told the labor market is strong, the truth is the exact opposite. So in this video, I'll show you how deep this collapse really is, what sectors are about to get crushed, and 3 smart money plays that you can make right now. Let's start with the scale of this mess. The Bureau of Labor Statistics just issued the largest revision to job numbers since 2002. Nearly 1 million jobs we thought existed don't. Unemployment has ticked up to 4.3%. That's the highest since 2021. And here's the truly terrifying number. Strip out healthcare and hospitality, and the US economy lost 24,800 jobs in August. Without hospitals and restaurants, we're already in a jobs recession. And the pain is lasting longer. The average duration of unemployment has hit 24.5 weeks, the longest since April of 2022. We now have 1.9 million Americans out of work for more than 6 months. That's not a temporary blip. That's structural damage. And meanwhile, labor force participation has slipped 0.4% over the last year, down to 62.3%. That's millions of people simply giving up. Manufacturing overtime has dropped to just 2.9 hours. Even the federal government shed 15,000 jobs in August. And look at the trend. In the first quarter, job growth averaged 111,000 per month. Over the past 3 months, just 29,000, a 74% collapse in momentum. For investors, that's not a soft landing. That's the economic engine seizing up. But here's the thing most people don't know. The BLS uses something called a birth-death model to estimate jobs from businesses opening and closing. This model has been systematically overestimating job creation because it assumes new businesses are hiring at pre-pandemic rates. They're not. Small business formation is down. Costs are up. The model is literally creating phantom jobs that don't exist. These fake numbers kept the Fed from acting sooner. That delay means when they panic, it's your job that takes the hit first. Now you'd think the experts would have seen this coming. Well, they didn't. Goldman Sachs just raised its recession odds to 45%. JP Morgan is at 60%. And listen to Mark Zandi, chief economist at Moody's. This only happens when the economy is in recession or about to enter one. Translation, the canary in the coal mine just dropped dead. And if you're under 40, you've never lived through a full Fed panic cycle, and it can hit your paycheck hard. And here's where it gets political. Most of these phantom jobs occurred during Biden's presidency, not Trump's. The revision covers April 2024 to March 2025. Trump actually fired the BLS commissioner over this, claiming that the data was cooked. Turns out he's probably right. This exact pattern, massive job revisions, a Fed pivot, and Buffett hoarding cash, happened before the 2001 and 2008 recessions. So let's break down who's getting killed, who survives, and where the danger zones are. Manufacturing has lost 78,000 jobs year to date. Tariffs are hammering supply chains. Construction has declined 3 months in a row, crushed by high interest rates. In tech, companies like IBM and Duolingo are openly bragging about replacing humans with AI. That's not a hiring slowdown, that's displacement. But the AI story gets darker. Goldman Sachs says if current AI adoption expanded across the economy, 2.5% of US employment faces immediate displacement risk. That's about 4 million jobs. And Gen Z workers, they've been cut in half at major tech companies as AI wipes out entry-level positions. Now the survivors. Healthcare is still adding about 31,000 jobs a month. It's slowing, but it's still the most recession-proof sector we have. Even then, job openings in healthcare are down 10% year over year. The pipeline is thinning. In the danger zones, professional services, highly vulnerable to automation, and retail, which lives and dies on consumer spending. With confidence crashing, these are the next dominoes. When the Fed panics and cuts rates, it doesn't instantly bring back jobs. If you're in retail or professional services, layoffs hit first, rehiring lags behind, and you're left exposed. So if you think this is just another routine slowdown, you might want to think again. Entire sectors are buckling. So where does the smart money go when the jobs market cracks like this? First, defensive plays. Healthcare stocks, consumer staples like food and household products, and utilities. These are the companies people can't live without. Second, value opportunities. Financials get crushed when rates rise, but rate cuts turn them into winners. Quality tech firms, not the hype plays, but the true AI enablers, will be trading at discounts. Infrastructure and construction will also flip once borrowing costs drop. Remember Warren Buffett's line, be fearful when others are greedy, and greedy when others are fearful. Buffett didn't just build cash randomly. He sold the absolute top in 2024, dumping 67% of his Apple stake and 34% of Bank of America right before the correction. Social media is calling him the greatest market timer of all time. And when the world's best investor is sitting on more cash than 47% of the Federal Reserve's own treasury holdings, you pay attention. Third, alternative assets. Gold is up 30% this year compared to the S&P at just 8%. Central banks are buying more gold than any time in history. Essential REITs, real estate investment trusts, properties that are tied to housing, healthcare, and logistics, they can also thrive as rates fall, and likely will. And don't overlook international diversification. A weakening dollar makes foreign assets more attractive. The World Economic Forum says 39% of worker skills will be obsolete by 2030. That doesn't mean all jobs vanish. It means companies that enhance workers with AI will win, while those replacing them outright will create a massive retraining industry. Think workforce development companies, AI training platforms, and cybersecurity. 43% of companies list it as a top priority. The AI revolution isn't just a risk, it's one of the clearest opportunities of the decade. And if you're under 30 working in tech, you're twice as likely to be unemployed today than you were 6 months ago. Now, let's zoom back to the Fed. Rate cuts mean bond prices rally. That's your chance to lock in yields while they're still elevated. Rate cuts also weaken the dollar, which boosts international investments and commodity plays. And every cycle, rate-sensitive sectors like real estate and infrastructure rotate back into favor. And here's your clearest recession signal. The last time the Fed pivoted this aggressively from higher for longer to emergency rate cuts was during the dot-com crash. Powell went from warning about persistent inflation to opening the door for 50 basis point cuts in just 6 weeks. That's not policy adjustment. That's panic. So what happens to your job if the Fed panics? First, hiring freezes spread. Second, weaker companies slash payroll to survive. Third, even if the market rallies, Main Street jobs lag 6 to 12 months behind. That's why workers feel the pain long before investors see the gains. So mark your calendar. September 17th is the next Fed meeting. By year end, we could see multiple cuts. The next BLS jobs report drops October 3rd. If it comes in weak, expect that 50 basis point cut and full panic mode. But here's the bottom line. 1, the jobs market is far worse than anyone realized. The revisions prove it. 2, the Fed is about to slam the brakes in reverse. That creates chaos, but also opportunity. And 3, you don't need to predict the future. You just need to position defensively, then lean into selective growth plays. And here are 3 moves you can make today. First, build your defensive base. 40% in healthcare, utilities, and consumer staples. Second, position for rate cuts, quality bonds, dividend aristocrats, and international exposure. And third, watch for AI transformation winners, education, cybersecurity, and productivity tools that help workers do more. The Fed can save Wall Street in weeks, but it takes months or years before your job security returns. That's why protecting your income streams now is critical. So if you can find income property that cash flows or can negotiate terms with sellers to force cash flow, income property can be one of those income streams that serves you now and in the long run. And if you're short on time and need some help with that, I pulled this video out right here for you to watch next. Thanks for watching. I'll see you next time. Take care.